Today we are discussing H&R Block, ticker HRB. Over the next few minutes, I'll discuss my thoughts on both the business quality and its valuation. First up, they have a market cap of $5.1 billion, enterprise value of $6.9 billion, so you see about $1.7 billion in net debt, which is a pretty significant amount of the overall enterprise value. You see the diversified and consumer services industry. They provide income tax preparation and return for DIY tax return preparation services and products to the general public, US, Canada, and Australia. So they have income tax preparation, they have refund, transfer, block your mold, prepaid MasterCard. But basically this is an income tax prep service for US and based customers. I would assume the bulk of their customer base is in the US, but that is just a guess. I don't know how much Canada and Australia play into this. They have a beta of 0.68, which is pretty significantly low for an average S&P 500 company. So that is an interesting number. The lower the beta, the typically the higher quality the business is. But one thing that's really gets me when I go to this return on invested capital chart is you can instantly see they had 3 years of loss in the last 20 years. This is relatively high for me. I want a company to be profitable at least 19 of the last 20 years before I really get super excited about it. And I see that they have losses here in 07, 08, and in 2020. What's interesting is all three of those years mark recessions, and so they do show to be somewhat cyclical. But year to year, that doesn't seem to be the case. You see 2013, 2014, 2016, you see very, very stable returns on invested capital, 19, 20%, 19, 19. You get up to 27, 36. Most years, they're earning double-digit returns. So the vast majority of years, they're actually earning really nice returns on invested capital. But this is so odd to me why they would exhibit this piece, because you have income tax prep services. In the US, if you're earning money, you have to do income tax returns. And so I would assume it'd be a pretty stable business model that you'd be earning fees each and every year. You probably have the ability to raise prices on a regular basis. I don't really know why these recessions would be such a big deal. Even in a recession, people still have to file their income taxes, so I don't really understand these numbers and why they make sense that way. Maybe they're relatively high priced, so then people seek cheaper services. Either way, they are exposed to recessions, but otherwise they're earning some pretty good returns on invested capital. I assume part of that is because it's relatively software-based and driven along those lines. Now, the 10-year median returns look really, really good. 20% return on invested capital, 37% return on equity. My targets are 10% for ROIC and 15% plus for return on equity, and they exceed these easily. Normally, these numbers would be an outstanding business. I just question why they're losing so much money. I would really need to understand the business. This sort of answer would be something that would be really key for me before buying the stock, is I'd probably have to ask management, what's going on, why they see that cyclicality, or go back and study some of those annual reports. Now, the 10-year CAGR on growth really ties into our PE ratio here, because at first look, the PE looks really attractive. PE of 10 is a cheap price, especially for a business that earns such astounding returns on invested capital. So it makes me think, why are you trading at a PE of 10? A PE of 10 means you get a 10% of return off the bat without any growth, which is important because they're not growing very fast. The revenue's grown at 1.8% a year. We can just round and call it 2%. So you have PE of 10, you're growing at 2%. Maybe you get the potential for something like an 11 or 12% return with a business like this, especially because you look at those returns on capital. They're not having to reinvest a lot of money back into the business. A lot of that capital should be available to be distributed to shareholders. Now, you do see some other interesting pieces here that really can get you excited about what you see. You see the assets here have declined over time. So they are getting more profitable, they're growing their revenue, and yet they're using less assets at the end of the decade than they were at the beginning. That can be really exciting. When you see something like this where its revenue goes from 2.9 billion, 3.4 billion, gross profit 1.1 billion, 1.5 billion, all of that occurring while using less assets is a really good sign. It's going to lead to operating leverage. You can see that they've gone from a 40% gross margin up to a 45% gross margin. So that's going to really boost your returns over time if you can do that on a regular, consistent basis. Likewise, we see that price to book is negative. Normally, some people say it's like, oh no, that's not good. Actually, what that's saying is because we know that your PE is positive, you know that that your PS is positive, that they're actually earning money. The only way you're going to get the price to book negative is if the book value is negative. How does that happen? It's almost always due to buybacks above book, and that can be a really attractive thing because you can really only see that with very predictable, steady businesses, which would be a little bit better than some of these numbers suggest. Because when I look at this operating profit, I see 771, 745. That suggests a relatively flat over the course of the year. That's a little less attractive. And it's kind of confusing because you had a gross margin expansion, but your operating margin's gotten a little worse. And that's somewhat of a negative sign for me. I don't really understand why that is. But we can see some pretty good numbers here as well. EPS going from $1.58 to $3.22. You've doubled your EPS over the decade. That's about a 7 to 8% EPS growth. So I'm a little confused why we're seeing 13% here with this number, but this could be some other numbers we'll see on a later page. They have been paying a pretty steady dividend. It's not growing very quickly, much at all, but you have been receiving a dividend over that time period. Now this dividend is about $1, and you have a $33 stock price, so you can see about a 3% dividend yield there. Now, where that can be a concern is your dividend's not growing very much. And the company's not growing very much. So unless you're getting a substantial return from your EPS, which of course here again, trading 10 times earnings, it's a pretty good price. Unless you're getting a lot of return through buybacks, which I do think are probably happening, you're not getting your double-digit type return simply from your dividend. So I am concerned about where that capital is going, what's being done with it. We're going to have to dig a little deeper on this. If you're enjoying it so far, hit that like button. Don't forget to subscribe. Let's go on to the income statement. So cost of goods sold, steady, pretty flat. I mean, you've grown your revenue, but your cost of goods sold is pretty steady, and that's going to lead to that operating leverage. You see that they've grown their revenue about 20% over the course of the decade, which is pretty low. That's only about 2% a year. Again, first place there, but your gross profit is up 50%. That's really good. When you see that operating leverage, it looks really good. The downside is look at this SG&A growth. They've doubled their SG&A growth. They didn't double their revenue. They didn't double gross profit, but they doubled their SG&A from $330 million to $800 million. That's a major concern because SG&A expenses are usually heavily under control of the management team, so they've allowed their expenses to kind of run away from them. Looks like maybe they had some sort of acquisition here in 2015, 2016 that really upped up their overall costs. But it is a concern that they've allowed their expenses to grow faster than their gross profit. I don't like seeing that. You can see that their peak earnings, in 2014, 2015, just before this happened, and they've really not gotten back to that number. So that is a concern. Now you do see substantial buybacks. So I was right on this sense. You start with 274 million shares outstanding. You're down to 171. So what is they retired about 100 million shares over the course of a decade. So almost 40% of the shares outstanding. That's pretty impressive. 35 to 40%. So you're talking about 3.5 to 4% per year boost in your EPS simply from buybacks. Now that's important because your net income is flat. So let's go back for a second to this overview page to really get an idea. You see these 10-year CAGRs, and the concern was like, well, how are these numbers playing out? Well, you're getting a 3% yield on your dividend. If you are generous and you say you're getting a 4% dividend or 4% yield on your buyback, then your total yield is about 7%. And you say you have a current 7% yield and you're growing about 1 to 2% a yield, maybe that gets you an 8 or 9% return. So your low end of this stock is something like a 7 or 8% return potential in this business. And for a business that's trading a PE of 10, high return on invested capital, that's a pretty good low end potential return. I like that I can see that sort of setup here because it means that maybe the downside risk isn't super high. Now, the caveat to that is this is potentially a pretty risky business. Income tax returns are going to be heavily open to regulation. They're going to heavily have to invest as changes in tax laws occur. There could always be a big change by the government to that could really send them into something like a risk of bankruptcy. So you always have to be careful of that. But otherwise, some good things we saw from that income statement. Cash and cash equivalents, they've come down a lot in the last 2 years. You see total assets kind of coming down. PP&E is not a big number here. So PP&E, $552 million. They don't have a lot of working capital here. But if we just said 500 million, we'll go back to this income statement, you see 500 million. So they're earning about 100% return on their tangible PP&E, which is a pretty good return, especially even if you throw in accounts receivable in there, it's over 50% returns. Very good returns on capital. So we know that piece. But the question is kind of where this money is going. You see these retained earnings. You do have long-term debt. Now, the big risk here is, of course, your long-term debt exceeds your total current assets. What about short-term debt? You don't have a lot of short-term debt. Your long-term debt exceeds your current assets, so there is some risk there. Again, there's not a lot that the company could sell off over time. If something deteriorates in this business that makes it harder for them to earn money on a regular basis, they don't have a lot of margin of safety on their balance sheet. That can be okay if the business is very, very predictable. It's just something that I would be concerned about if I had any doubt in their ability to sustain profitability over time. And we have seen some massive drops in their returns during recessionary years. So you really need to understand that business cycle if you're going to invest in a company like this. PP&E relatively low. So they do have stock-based compensation. So it looks like somewhere between 15 and 30 million. Now you do see the buybacks. Now the buybacks are not every year. That's the first downside here, is that the buybacks are not steady. You can't really rely on them as sort of a regular return. You see in a single year here, you had, $2 billion in buybacks. And then you had, some years with almost nothing. So some years your share count might go up. Some years your share count's going down. Generally, the share counts are going down steadily over time because of the buybacks being so much bigger than stock-based comp. I mean, here you have it 15 times what it was in 2017. But it's certainly not slow and steady. Looks like maybe they took on debt to do a buyback in 2016. They took on debt in 2020. What about acquisitions? They don't really have big acquisitions. So I don't know what happened with all that employee cost, but something definitely happened there. They're actually paying less out in dividends than they were a decade ago in terms of absolute value. So why are they not growing the dividend rate? This is a problem with slow growing companies, is they're just really hard to manage and hard to predict. I mean, you have a company that has all the bones of a high quality business. It's relatively predictable. It's very strong returns on invested capital, really strong returns on equity, but there is some cyclicality. I don't know what's driving this or why recessions hurt them so much. You would think even, in a year where you lose a job, but if you have some earnings, you're still going to have tax prep services. But this could just be something that I don't understand their business model. But where I get concerned with a business like this is I'll look at it and say, hey, this is high quality. You see these numbers. You see that they were still 17 years profitable. You see a pretty cheap price, PE of 10. This is a cheap price. You see stuff I like from capital allocation. They're paying a 3% dividend. You have a 3 to 4% buyback. You're getting a lot of capital returned to you as a shareholder, and they don't have to retain a lot in order to justify it with their median returns. But there's risk here because am I wrong on the quality? You have these two gaps, these 3 years here where they had losses. They are with recessions, and maybe recessions are really bad for them. And then you don't have the margin of safety on the balance sheet because when we go to that balance sheet, you are getting this negative shareholders' equity, negative book value, and that's coming about by the fact that they have this long-term debt that's so much bigger than their total current assets. When you have that setup, that's just really hard for them to manage because if anything happens to the income statement that drives them into losing cash in a certain year, it could threaten their business because the balance sheet doesn't have the support that you would otherwise have. If a company makes profits 20 straight years or 40 straight years, that doesn't matter. But if you do have years with losses, then it can become a problem. So for me, H&R Block started out where I was excited with the numbers I was seeing, excited at the price, but for me, it's not going to go on my watch list because I can't understand why they're losing money like they are in recessions. This should be a business that should be a lot more predictable from my point of view, and so for that reason, I'm going to pass on it. If you learned something from this video, if you like my content, please hit that like button. Don't forget to subscribe. And if you want to check out this software, quickfs.net, my affiliate link is the link in the description below. Please use my link to support the channel. Thank you for listening, and until next time, stop paying fees, start building wealth.